All right, hey guys, I want to go over a couple of charts for you, which will prove that we're about to have a massive crash. Now, look, there's a lot of information out there, a lot of false information, a lot of opinions, a lot of people, basing things off economic information. It was like this last time, all that sort of stuff. A lot of that stuff does count, but nothing beats this chart, period. What you've got here is the 30 and the 2-year government bonds. Every single time we have a stock market crash, not a correction, a crash, this chart predicts it correctly every single time, and it has for the last 38 years. What you've got here, the green and red candles, is the S&P 500. The percentages in the box is the drawdowns that have been suffered each time the signal has triggered. Now, what is the signal, you may ask? What it is the spread between the 30-year and the 2-year and the ratio of those two. Any time that the RSI crosses through the 50% level, we get the stock market crash. At the same time, the MACD, and it looks flat here in this area, but I'll zoom in, I'll show you it's not. At the same time the MACD crosses through the 0% line, and our stochastic is pointing up. Now, the stochastic doesn't really matter that much, but it's a good indication to have it as well. So look, we're going to start here at the first crash of 1990. Now, things were a little bit different back then. We weren't able to track everything. But this one's a bit of an outlier. You can see here, this was the first month the market moved down. These are all monthly candles. And as we shot through that 50% range, triggered the crash. And the MACD at that point was negative 0.009 from the center line. The pink line represents the first month that the market went down. The next crash is 1998. You can see here, we've smashed through the 50% RSI level. It's actually at 47, but you can see it goes through the next month. At the same time, the MACD broke through the zero. Now, the 98 crash was basically a prelude crash to the 2000. The 2000 crash is the big one. You can see here, we broke through 55% on the RSI. That was the first month that it smashed straight through there. We have a look at the MACD. We were at negative 0.029. Remember that number because it's going to become relevant. And you can see we smashed through the zero line. The next crash, the big one, which was a 57.69% drawdown. We signaled the 50% signal here in August 2007. You see it's 50.63%. Then the signal of the MACD was at 0.029, or negative 0.029. When it went through, that was the first month the market moved down. I'll bring up that MACD so you can see it. The next crash, which was COVID, people will assume it was because of the virus. It wasn't. We don't need to say why. Who cares why? The charts tell us everything. Anyway, same deal. 58% RSI. Now this one, because it did happen rapidly, the MACD took a little bit more time to catch up. So we're going to discount this one from any analysis that we're doing. So where are we at right now? As you can see here, I've been tracking this for months. Recording all of the daily information. We're currently sitting at 49.38%. We have actually already broken through the 50% RSI for the month of December, as you can see here. However, there has been manipulation in the bonds market, specifically by Bill Pulte, which is from the federal housing sector, where Trump has instructed him to buy $200 billion worth of mortgage backed securities. That is why the RSI has dropped off. They're trying to avoid what the inevitable is going to happen, but the inevitable is going to happen. Now, when we go over to this is a daily chart of the exact same chart. And these candles are not the S&P. This is the actual spread between the 30 and the 2-year. On the 8th of January, so right there, that is when he was instructed and committed to buying the mortgage-backed securities. And as you can see, a lot of damage was done to the chart. However, I'm sure you're all aware of the information that's come out over the weekend, and we have a doji candle there. We're going to see what happens next week. This chart here is the 10 and the 2-year. What we're looking at here is every single time this blue yield curve inverts and then re-inverts, we get the signal. This signal is generally either on time or early for the stock market crash. The pink line is representing the first month that the market moved down. So you can see here on this first line here, in June 89, we triggered the signal for the crash that then came in June 1990. Here in 98, we had what would be considered the correction or minor crash at that point. We inverted and re-inverted. Down here, we had the first month that the market moved down, which was in September 2000. Now, when we're looking at this one, the yield curve was inverted still at this point. It re-inverted here in December 2000. This is important to keep in mind because it doesn't mean that the market will stay up if it was signaled here in September and then crash when it does the second part of the re-inversion. It just means that it's now fully happening at that point, which is important and relevant to today's signal. Here, we've had the inversion and the re-inversion, and you'll actually see there we had a decent pullback, enough to shake some people out. Again, here, we've inverted and re-inverted, which was in March 2007. And then we've had the big one where it's taken off from that point. And you can see there, at that point, that was the first month that the market went down. Like I said, this chart, the 10 and the 2, is not always on time. Here for the COVID crash, we've inverted and re-inverted in September 19, which is obviously a lot further ahead than when the crash actually occurred, January and February 2020. Now to the present day, September 24, we went under and we have re-inverted. We've stayed up. We're curling back down presently because of the manipulation that has been taking place. The question would be, is this the first time ever that someone could avoid the stock market crash? The answer is obviously not. They can delay it all they want, but they're not going to fix the underlying sickness that is building these pressure ratios within this chart or charts. So this is going to happen. You need to be prepared. Now, you'll remember I said 0.029 being a critical number. Right now, we're at 0.061. We're not far off. Next month, we're more than likely going to be printing 0.030 to 34, roughly in there. Now, that doesn't mean that the market is going to stay up right now or sideways or go down. What it means is it's going to crash very soon. We're not far off. When we go over and we have a look at the bonds, the 10-year here in the middle broke out the other day. This is signaling a lot of issues. You'll also notice that we have a head and shoulders pattern, inverted head and shoulders. So left shoulder, head, right shoulder. We have that on all three charts. Now, the 2-year breaking out here is what is suppressing that ratio at the moment. What we need to see is the spread difference between the long end, the 30, and the 2-year. Because of the manipulation in regards to timing of the crash, this time the timing could be different. Now, in the last video, I went over Fibonacci levels for you. I suggest you have a look at that and look into Fibonacci levels. Basically, what we do is we take a stock market low to a stock market high to a stock market low, and that gives us the Fibonacci levels. You'll notice that is the 100% measured move there, which came in at the February top. The next impulse move gives us the 100% measured move, which came in the March 24 top. These candles are weekly candles. The next move gave us the February top of 2025. Because this is on the first wave, second wave, third wave, fourth wave, fifth wave, we're still starting from the same move there, and we're getting the 100% measured move right now in this area that we're in currently. When we look at the Fibonacci for the retracement, it also works very similarly. If we go off the market high, the low to the high, we get a 100% pullback area. And you'll notice right there is the area that the market pulled back from that crash, which was the December 21 bear market, 2022 bear market, I should say, starting in December 21. The next move from that high to this low to this high gave us the 100% measured move area for the April crash of the tariffs. Now, if we take the same high, low, and the current high, the 100% measured move area is down here at 5673. Personally, I think we're going to actually go a lot lower than that this time. However, that would be the 100% measured move area. Now, keep in mind, we've been trading within this parallel channel for the last 5 years. We've tagged the bottom here. It's acted as support here, 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 and here. We've tagged the top here and here. We've also tagged the top here. And we've attempted to tag it a second time here, which is quite similar to when we've tagged it twice here. Now, does that mean we're going to tag it again? We don't know. What we do know is this chart. This chart has correctly given us weekly data for when the stock market is going to correct or enter a bear market. There's some simple rules to this. So the first one is the orange line here. This is on a weekly chart. So this is your XLP to SPY ratio chart. This chart is also available here in the free Discord if you wish to join. Now, on this particular chart, got some notifications popping up here in the futures. Okay, we'll check that out later. So this particular chart, what we're looking at here is the orange line is the 10-week moving average. And any time that we cross that 10-week moving average, the market is in distress. Essentially, the consumer staples or defensives are outperforming the SPY. Now, when we cross the green line, this is the 50-week moving average, and the black line is the 10-month moving average. Obviously very similar, but they do move in different places. You'll see that throughout the chart. Now, these pink arrows above is when the XLP has crossed the ratio chart, obviously, has crossed the 10-week moving average. And you'll see there's a number of times here that are not that relevant. However, it is building up here. The green diamonds are buy signals from using the buy and sell indicator, which is available to some members. The purple arrow underneath the candle is an uptrend change signal, which is also an indicator that you can use. Now, the important part with this chart in correctly showing when we are about to enter a correction, not a crash yet, a correction, is when we get above the 10-week moving average, and at the same time, the MACD is coming up from a low point and crossing up. From there, it can continue to build. So if we have a look here for the 2025 tariff crash, we crossed the 10-week moving average 3 weeks in a row here prior to the crash beginning. And then we solidly went above it. Right now, we are solidly above it and are likely to continue given the information we've received over the weekend about various things throughout the world. Now, as you can see here, we've then crossed both the 50-week and the 10-month moving average, which has indicated that we were entering into a bear market territory at that point. This chart is never wrong. Every single time you can see that we cross, we go down. Now, again, it is important that it is a confirmation between the two signals that the MACD is coming up from a low, not coming up from above, down. It must be coming up from a low at the same time. So if we go over to the next time that it came up from a low, we went above, MACD crossed up from the low, and the market went down. This is a significant move down, 26% correction. Same thing happened with the 2020 COVID crash. Several signals crossing the line, and then again crossed it, the 10-week moving average, as well as the other moving averages. MACD came from a low, crossed up. We've had 3 signals there. Here, in 18, you've had another signal. So it's much more responsive, this chart, being that it's a weekly chart, but it's basically telling us at the moment that we're going to enter a correction phase. Money has repositioned into consumer staples. We can confirm that signal with the consumer discretionary to consumer staples ratio chart anytime that it breaks down above its 10-week moving average. I like to personally use this one. This one just also confirms it. Now, the next part of this is the TLT to SPY ratio chart. This also confirms the signal. However, it hasn't confirmed the signal yet this week, or the last week, I should say, because there's been the manipulation within the bonds market specifically, like I mentioned earlier. So that is why you're not going to be seeing that manipulation as the TLT moved down. Now, this chart should be noted that it lags. It's a confirmation, but it lags. Every single time that it does cross, again with that MACD coming from the low, it's accurate, but it is a lagging indicator. So given that there is manipulation as well as the lagging of this particular chart, it should still be considered. Now, when we go over to the VIX futures ratio chart, this chart has correctly predicted 90% accuracy market changes. So anytime we drop down, we then roll over soon after. These signals that you're seeing on the chart, the green candles are when we're in an uptrend from the trend indicator. The red candles are a downtrend. The yellow is the signal of the start of the downtrend, and the purple is the signal of the start of the uptrend. The diamonds, the green and the white, are buy signals. The red are sell signals. S&P 500 down the bottom and the ratio chart up the top. You can see previous videos where I've described how to correctly use this ratio chart with the S&P chart. And I think I also used it against the QQQs in the last video, where we showed if you use both of these charts combined, you would have a 57 or 59% gain for 2025 utilizing both charts. We've had this signal come through here on the 7th of January, where we had the sell signal combined with the downtrend change at the same time. We've then had an uptrend, which has signaled that it should have been okay, which immediately snapped back into a downtrend, and now it is continuing to move down. Obviously, things will continue to get worse, is what I'm indicating. Now, the next question you're probably going to be asking is, when should I buy back into the market? Well, it's very simple. This is a members only chart. It indicates when to buy back in. It is simple to recognize. Basically, a couple of weekly red candles followed by a weekly green, market breadth dropping below 15% and then back above again. Every single time it has correctly predicted market bottoms, when to buy in. Every time. It will not be wrong this time, and we will be ready and waiting. What this chart can also show us on a weekly time frame for SMH. Every single time that we've gone above the 100% area from the 200 moving average on SMH, we've snapped back to a recovery. So you can't get too far away from the 200 moving average like this on the weekly chart. 104%, 102% snap back. 108% snap back. 104%, we're about to snap back again. I'd like to also show you this channel that we've been trading in since 1929. You can see that there's definitive interaction with the 50% line, acting at those points as a resistance and support. And again here. Currently, we have broken out above this channel. We may pull back at some point. It could be back to the 50% line, potentially. We don't know. We'll have to find out. Anyway, that is the update for you guys. I think that we're going to have a major correction soon. Please like and subscribe. Share this video with friends and family. If you are holding any positions currently in the market, you should consider your options. Thank you.